Okay, for part 2 of chapter 4, we're going to talk a little bit about the process of financial planning. Now, we in class will go through some exercises with pro forma analysis, but in general, this is just a conceptual basis for what the process is all about. So, obviously, the financial planning process starts with the long-term strategic plan of the company. From that long-term plan, things dwindle down and trickle down into short-term operational kinds of plans. So in general, financial planning then has really two objectives or two aspects. There is a cash planning component. Right? We want to understand what the company's needs are for cash, both on the short term and the long term. We also want to understand a little bit about what they refer to as profit planning, which is a more long-term forecasting of financial statements. We want to see how the company has been planning with respect to financial ratios over the past several years. But what about proposed changes? How will changes in the economy, in the industry, in the company itself, how will they ultimately impact the financial statements of the company? That's what this pro forma analysis is all about. So on the long-term side, we're talking about a 2 to 10 year window. We're really focusing primarily on the changing needs of assets in general. What kind of plant and equipment is going to be needed to function as a company moving forward, given the forecasts of income and the potential changes in expenses. So we want to look at these kinds of activities to incorporate them, right? What are the fixed asset needs? Research and development. What's the capital structure of the company? And what are the actual sources of financing that are available? All of those components are incorporated in this long-term plan to try to determine where the company is going to go down the road. On the short-term side, we want to focus primarily on the cash budget itself. What cash is needed on a month-to-month basis to keep the company running and moving forward? So this cash budget, again, is very short-term. It's probably not going to cover much more than a 1 year period, but it's going to incorporate the seasonal nature of the company. So there's going to be a variety of forecasting, a variety of decisions made by management as to how the cash actually comes to the company. As you can see, the general format of one of these cash budgets says, we need to know what the cash receipts are for January, what we expect them to be. What are the cash disbursements? That gives us net cash flow. We add the net cash flow to the beginning cash flow. That gives us then the ending cash flow. For the corporation, we probably are going to have a minimum cash balance. It's a calculation that we can make, but in general, a company needs money. If you're a retail store, you need to have cash for petty cash. You need to have cash to put in the cash registers to make change. So there's a certain amount of minimum cash that's required. Now, the difference between the ending cash and the minimum cash, if it's a positive amount, it means there's excess. If it's a negative amount, it means there is a deficit. This is what we're ultimately planning for. We're planning for this stream here of required financing after we have incorporated the decision-making process. So how do you ultimately then deal with uncertainty? Right? Well, maybe we'll want to use some best-case scenarios. We'll talk a little bit about analyzing risk and how this sensitivity analysis process works, but we want to incorporate a statistical analysis of what the company sees, maybe a statistical analysis of what the industry sees, and incorporate that into this forecasting process. But again, in the end, since this is a forecasting process, there's always going to be a level of uncertainty. So what about the profit planning or the pro forma statements? And we're not going to get into a great detail in this particular lecture, but in general, what we want to do is predict the financial statements at least for next year. More than likely, we want to do this for maybe 5 to 10 years down the road. But what do we need to know? We need to understand what the financial statements are currently, right? We need the most recent financial statements. We need to have a forecast of sales. And then in the end, we also need to have an understanding about how the line items in the financial statements change relative to sales. So again, this is a forecast. It's going to be based on some assumptions. So we need to understand ultimately how this follows through. So here we have a company. They have their sales. This is their income statement. And of course, in the end, we know that what? Here's the sales of the company. We need to know that the company actually finances some of its operations, and some of the ending profits ultimately go to retained earnings. So we really want to answer or ask a question. If sales changes, if this number increases next year, how will all of these line items be impacted? That's part of the analysis. Once we have determined here is the current balance sheet, but let's say that we expect total assets to increase by $10,000. If you look back here, retained earnings next year is only going to increase $3,650, at least that's our forecast, $3,650. So if we need $10,000 in assets, where's the money come from? $3,600 of it comes from retained earnings, but all the rest has to come from some other form of investor. We may have to go externally to get the funds needed to finance the company moving forward. So again, here's our forecast. We know that sales are going to increase. So this process of using sales is something referred to as the percent of sales method. We start with the sales forecast and we predict things moving forward. Some of the expenses of the company don't change with sales. For instance, interest doesn't change just because sales change. Interest changes when changes happen to financing. But we can use the past cost and expense ratios from our financial statements to get an understanding of what the company has realized in the past. Of course, the trick then, the disclaimer is, does the history of the company adequately reflect the future? And the answer to that, of course, is probably not exactly. So again, we come back to this idea that this is a prediction. By its very nature, it is incorrect because it is a forecast. So we're going to work through this through the class on how this process actually works. The major weaknesses are, as I just mentioned, past performance is used. Certain variables, we can force them to take on some desired values, but just because they're desired, does that mean that they are the correct values? So again, the challenge here is to introduce and have an understanding of how forecasting works in the company. We'll work through this process, but again, it's not the most straightforward. It's not the easiest process to understand. Once we have these things created, though, how can we use it? We can look at the ratios. We can calculate inflows and outflows of cash. We can try to figure out what can the company do to change the direction of the company. What would happen to the company if we decided, as we said in an earlier example, I think the days sales outstanding was increasing. We don't want to increase, we want to decrease. So what happens if we can force it? Let's say we want the day sales outstanding next year not to be 50 days, we want it to be 40 days. Well, what does that decision do to the financial ratios of the company? How does it affect cash? How does it affect the balance sheet? That is the ultimate goal of this pro forma analysis. It is a critical tool used by management to understand what's going on, not just today, but also with changes that they want to use moving forward.